Good afternoon, ladies and gentlemen, and members of the press. The Monetary Policy Committee met on the 21st and the 22nd of May 2018 against the backdrop of optimistic global growth outlook and sustained recovery in the domestic economy. The committee examined the performance, risks, vulnerabilities in the global and domestic economies up to May 2018. The outlook for the rest of the year. In attendance were 9 members of the committee. Global economic development. The momentum of global economic activity remained broadly sustained, with outcomes likely to be shaped by emerging geopolitical issues, including easing geopolitical tensions on the Korean Peninsula, reduced trade tensions between China and the United States, United States withdrawal from the 2015 Iranian nuclear deal, easy financing conditions in the Euro area, the UK and Japan, as well as difficulties associated with the Brexit negotiations. Accordingly, global output is projected to grow at 3.9% in 2018, up from 3.8% in 2017. Growth in the advanced economies is projected to strengthen to 2.5% in 2018 from 2.3% in 2017, premised on improved investments and consumption spending. Similarly, output growth in the emerging markets and developing economies is projected to rise marginally at 4.9% in 2018, reflecting improvements from the 4.8% in 2017, led by oil exporters such as Russia, Brazil, and Nigeria. The committee noted that despite these optimistic developments, the downside risks to global growth include the geopolitical tensions in the Middle East, lingering uncertainties from Brexit negotiations, growing trend toward trade protectionism. Inflation in the advanced economies is projected to rise by 2% and will remain subdued relative to the long-term trend. In the emerging markets and developing economies, price developments could surge by 4.6% in 2018. The International Monetary Fund forecasts that inflation will rise modestly over the medium to long term due to rising asset prices and long-term yields in the major financial markets. Domestic output development. Committee noted improvements in the domestic economy attributable to the steady decline in inflation, rebound in oil prices, and increase in production levels, as well as the continuous stability in the foreign exchange market. According to data from the National Bureau of Statistics, real GDP during the fourth quarter of 2017 was revised upwards from 1.92% to 2.11%, while a growth of 1.95% was recorded in the first quarter of 2018, up from a contraction of 0.91% in the corresponding period of 2017. The development was due to growth in the oil and non-oil sectors by 14.77% and 0.76% respectively. The Monetary Policy Committee also noted the sustained positive outlook based on the manufacturing and non-manufacturing indices, which rose from the 13th and the 12th consecutive months to 56.9 and 57.5 index points, respectively, in April 2018. The committee welcomed these developments, but believes that growth remains largely fragile and could benefit from further reforms and stimulus to strengthen growth. In this regard, MPC urged various levels of government to accelerate the settlement of contractor debt and salary arrears, as well as facilitate the quick implementation of the 2018 federal government budget. Developments in money and prices. Committee noted that money supply M2 grew by 2.16% in April 2018, from 1.26% in March 2018, annualized to 6.48%. This was in contrast to the professional growth benchmark of 10.48% for 2018. The performance of M2 was mainly driven by the growth in net domestic credit NDC of 6.24%, annualized to 18.72%, owing largely to net credit to government, which grew by 46.13%, annualized to 138.39% against the professional benchmark of 54.97%. Credit to private sector, however, contracted by 0.16%, annualized to minus 0.47% in April 2018, in contrast to the professional annual benchmark of 5.64%. Net foreign assets NFA grew by 7.38% in April 2018, annualized to 22.13% compared with the professional benchmark of 18.15%. Narrow money M1, however, contracted by 3.31%, annualized to minus 9.94%, compared with professional benchmark of 8.04%. Inflationary pressures continue to moderate, with headline inflation year-on-year declining for the 15th consecutive month to 12.48% in April 2018 from 13.34% in March 2018. Food and core inflation also decreased to 14.80% and 10.94% from 16.08 and 11.18% respectively during the same period. The average interbank call rate decreased to 3.34% in April 2018 from 9.49% in December 2017. Similarly, the average open buyback rate OBB rate fell to 2.96% in April 2018 from 8.46% in December 2017. The movement in the net liquidity position and interest rates reflected the combined effects of open market operation, OMO auctions, foreign exchange interventions, and statutory allocations to state and local governments. Committee welcomed the sustained improvement in the level of external reserves, which stood at $47.79 billion on May 18, 2018, compared with $46.73 billion at the end of March 2018. The committee urged the bank to sustain this momentum and continue to boost investor confidence in the economy. The committee also welcomed the continued rise in the price of crude and called on the federal government to seize the opportunity to build fiscal buffers against future oil price shocks. The All Share Index ASI decreased by 6.6% from 43,330.54 on February 28, 2018 to 40,472.45 on May 18, 2018, owing largely to profit-taking activities by investors and capital reversals in response to monetary policy normalization in some advanced economies, particularly in the United States. Similarly, market capitalization fell by 5.7% from $15.55 trillion on February 28, 2018 to 14.66 trillion on May 18, 2018. The committee noted the need to maintain remunerative domestic rates to help stem the trend towards huge capital outflow. The committee welcomed the continued stability in the foreign exchange market, promoted by improved dollar liquidity in the market due to the high level of activity at the investors and exporters window that is equally driving rates towards and at all segments of the market. Total foreign exchange inflows through the economy from January to March 2018 stood at 24.719 billion, of which funding from the CBN was 8.81 billion or 28.5%, while autonomous sources accounted for the larger balance of 15.91 billion or 71.5% of the total. In addition, the committee welcomed the $2.5 billion or 15 billion renminbi currency swap between the Central Bank of Nigeria and the People's Bank of China. This swap, the committee noted, will ease pressure in the foreign exchange market by the reduction in reliance on a third currency for trade settlement between Nigeria and China. They further noted that this swap arrangement could be the basis for an expanded and mutually beneficial economic relationship between Nigeria and China. The overall outlook and risks. The macroeconomic environment that propelled the economy's exit from recession has remained positive and is likely to continue in the near term. The forecast was premised on speedy implementation of the 2018 budget, improved security, continued stability in the foreign exchange market, as well as increase in crude oil production and prices. The committee noted the downside risks to the outlook to include the late approval and implementation of the 2018 budget, farmers-herdsmen conflict, weak demand and consumer spending associated with outstanding salaries and contractor debt, and the growing level of sovereign debt. The outlook for inflation indicates continued moderation in the price level. The risks to the outlook include the huge liquidity injections that is expected to arise from the implementation of the proposed 9.12 trillion 2018 federal government budget, expenditure towards the 2019 elections, monthly FAC injections, approval and implementation of the proposed new national minimum wage, and the possibility of the supplementary budget to finance it. This could impact aggregate demand and put pressure on domestic prices in the remaining months of 2018 and may dampen the gains already made by the bank in stabilizing prices. Star forecasts, given the anticipated liquidity injections into the economy, indicates upward trending pressure on domestic prices from the second half of fiscal year of 2018. Consequently, the committee advocates an orderly injection of the anticipated liquidity by the fiscal authorities to prevent a negative shock to prices that will derail the positive but fragile recovery so far achieved. Given the CBN's interventions, the current level of oil prices and developments in the global economy, we expect rates to remain stable in the foreign exchange market in the near term. However, the bearish signs in the capital market associated with profit-taking calls for a careful calibration of policy so as to moderate the tempo of capital outflows in an era of monetary policy normalization in the United States. There are already indications in other climes of severe attacks on foreign exchange markets of some emerging economies. Nevertheless, there are significant high level of uncertainties that could arise from the fiscal operations of government in the near term. Among these, the implementation of 2017 budget will end, proposed level of exposure to the domestic and external markets in 2018 in the face of dwindling revenue projections, as well as the full implementation of the 2018 federal budget. Thus, while we expect an expansionary fiscal budget in 2018, we are not certain of how far they could go, especially leading up to and including during the third quarter of 2018. Consequently, we expect a likely bunching of government spending in view of the late passage of the budget and government's commitments to honor prior obligations. This could pose a serious challenge to the bank's price stability mandate, given the need for an eye on growth. Revenue is expected to increase in view of the favorable prices of crude oil and improvements in non-oil revenue, particularly taxes. In addition, production levels have also increased in recent times, and this is expected to be maintained. However, the implementation of a China-US trade deal and implications on China's oil imports from Nigeria remain unclear, especially that the US has included energy imports on the list of items for negotiations with China. The considerations of the committee. Committee expressed satisfaction on the positive outlook in the domestic economic environment as the real gross domestic product grew for the fourth consecutive quarter in the first quarter of 2018, and a positive trend in the manufacturing and non-manufacturing product purchasing managers index in the first quarter of 2018. It noted the continued deceleration in headline inflation, as well as stability in the foreign exchange market, and therefore called on the bank to sustain the momentum in order to further subdue inflation and ensure growth. The committee expressed satisfaction with the level of activities in the investors and exporters window of the foreign exchange market. The committee further noted the overall upward growth momentum of the economy, with key activity sectors returning growth. Despite the improving macroeconomic environment, the committee noted that disruptions to the supply chains in the major food-producing states of the country remains a concern, and food prices remain sticky downwards. It also noted the potential adverse effect of the rising global inflation on domestic prices, and therefore urged the government not to relent on curtailing the security challenges to advance controlling inflation to its historical path. Members of the committee were satisfied with the progress made with the implementation of the Economic Recovery and Growth Plan, but were concerned that the delay in the passage of the 2018 Appropriation Act bill could derail it, and urged the federal government to sustain its implementation to further accelerate the economic recovery thus far achieved. The committee also urged the government to set the machinery in place for effective implementation of the 2018 budget to further stimulate the economy. The committee also encouraged the government to sustain current efforts at boosting tax revenue regeneration, notwithstanding the increase in crude oil and other commodity prices. The MPC, however, noted the potential effect of expansionary fiscal budget of 2018 and the liquidity impact of rising Federation Account Allocation Committee distribution following increase in prices of crude oil, as well as election-related spending build up towards the 2019 general elections on prices. The MPC also took note of the improved performance of deposit money banks and observed that the relatively high levels of non-performing loans in the industry was moderating, and urged government to promptly settle outstanding contractor arrears as earlier promised. Committee commended the efforts of the bank in achieving the positive outlook for the industry and advised the bank to intensify efforts to further improve banking sector soundness. The committee also called on the bank to sustain its monitoring apparatus over the deposit money banks to ensure compliance with existing prudential regulations and early detection and management of emerging vulnerabilities in the banking industry. The committee similarly encouraged the bank not to relent in ensuring that liquidity continues to flow from the banking sector to the real sector to further strengthen economic recovery and employment generation. The committee appreciated the authorities for paying attention to the payment of contractor debts and called for acceleration of efforts to assist in reducing the high level of non-performing loans. Committee's decision. The committee critically evaluated the policy options in terms of developments in the international and domestic environments, noting in particular progress made in stimulating output growth, including stability in the foreign exchange market, an increase in the level of foreign exchange reserves, and sustained deceleration in the rate of inflation. The committee considered the forecast of high liquidity injection in the second half of 2018, upward pressure on prices, driven largely by substantial expansion and fiscal policy, which would arise from the late passage of the 2018 appropriation bill, outstanding balance from the 2017 budget, and the pre-election expenditures. Tightening would ensure the mop-up of excess liquidity, mindful that despite the moderation in inflation, the current inflation rate is still above targeted single digit, and that real interest rate only turned positive in the review period. The objective of the policy stance, therefore, would be to accelerate a reduction in the rate of inflation to single digit, to promote economic stability, boost investor confidence, and promote foreign capital flows with complementary impact on exchange rate stability. Conversely, the committee believes that raising interest rates would, however, depress consumption and increase the cost of borrowing to the real sector. Moreover, such policy would make deposit money banks to reprice their assets. In reviewing the choice of loosening, the committee evaluated the potential impact of stimulating aggregate demand through lower cost of credit. Nevertheless, the committee deliberated on the effectiveness of the choice at a time when liquidity injection had been forecast to rise tangentially in the second half of the year. The outcome, therefore, would most likely exacerbate inflationary pressures, cause higher pressure on the exchange rate, and as demand for forex increases and return real rate into negative territory, as nominal interest rates could be less than inflation. Owing to the poor transmission mechanisms as a result of structural rigidities, the reduction in the MPR may not necessarily transmit to lowering market lending rate on account of high cost of doing business. The committee further noted that loosening could worsen the current account balance through increase in importation, margin lending, lowering of risk evaluation in accessing loans, which will drive up loans and likely increase non-performing loans with potential negative consequences on the stability of the banking industry. The cost of liquidity management would also rise considerably. The committee, while arguing for a hold, observed that the downside risks to growth and upside risk to inflation appears balanced as growth is improving while inflation is moderating. Maintaining the current policy stance would sustain gradual improvements in both indices. It was noted that there is need to see how all the components of the gross domestic product would evolve in the second quarter of 2018 in order to gain greater clarity on the direction of monetary policy. In summary, The predominant argument for a hold at this time is to await more clarity on the evolution of key indicators, that is, the passage of the budget and implementation, economic activity and traction in fiscal policy in 2018. Overall, the committee was convinced that the economy needed a new impetus of increased lending by the banking system and would work with the banks to encourage deposit money banks to adopt innovative ways to accelerate credit growth, including by a reduction in the policy rate when conditions for such a decision arise. The MPC noted that at single-digit inflation and high reserve levels, the risks associated with a policy rate reduction under conditions of wavering foreign capital inflows and an unstable oil market, including other severe uncertainties, could be better managed to deliver macroeconomic stability in Nigeria. In consideration of the foregoing, therefore, the committee decided by a vote of 8 members to retain the monetary policy rate at 14% alongside all other policy parameters. One member, however, voted to increase the MPR by 50 basis points. So that member wanted us to tighten, but lost. Consequently, the MPC voted to retain 1. MPR at 14%, CRR at 22.5%, liquidity ratio at 30%, and asymmetric corridor at plus 200 and minus 500 basis points around the MPR. I thank you for listening.
Good afternoon, Governor. My name is from Radio Nigeria. Yeah, the committee advised the bank to look for creative ways to ensure that credit flows to the private sector. What are these innovative ways?
Good afternoon, sir. Mr. Governor. We need much from Business Day. Mr. Governor, you told us last month that you expect that inflation will stay at the upper single digits or upper single digits or lower double digits. And now, and now you seem to be raising fears that that may not be met, considering the record budget over 9 trillion naira, expansion in FAC allocations, and although election spending. Now, do you now think that your current monetary measures are enough to handle that and keep inflation at that level, at your expectations? Or are you considering any other strategy?
Good afternoon. My name is Raliet from Classic FM. You spoke about the currency swap deal. When is it going to come into effect, and what are the modalities?
Yes, negotiation with the People's Bank of China that we eventually struck the deal for a currency swap deal between Nigeria and China, basically with intention to boost trade relations between Nigeria and China. Basically, how it works is that, like you already know, it will just operate the way normal 4M or LC transactions happen. Like you know, there are some importers from, for instance, England that will give you invoices in pound sterling if you want to import goods from, say, England. Or in Europe, they will issue you invoices in euro as against the dollar if the choices are there. So under the China-Nigeria deal, what we are saying is that FOMEMs, or whatever name it will be called by the time the framework is released, we will begin to see that Chinese suppliers will begin, based on the negotiations with Nigerian importers, will begin to issue invoices in renminbi. And if you consider that China is Nigeria's largest trading partner, controlling close to a market share of almost close to about 35%, What that means is that all things being equal, if we are able to, by the time we conclude the framework, we should see to it that you will find invoices more in renminbi rather than in the traditional dollar. So you can translate that to or make whatever conclusions you want to make. Because I had read in some papers yesterday about some wrong conclusions about the China deal. But I can tell you, in the overall, it is going to be positive, and I repeat, strongly positive for Nigeria, for Nigerian imports, and also for Nigerians. That's what we expect, and we will ensure that we achieve that. This was a negotiation that was painstakingly done, and I'm optimistic that Nigeria will reap the positive impacts from this, and we do expect that by the time the framework is released, that Nigeria will end up being the renminbi trade hub in the West African sub-region, because there are only 3 countries in Africa that currently enjoy the swap deal between China and themselves: South Africa, Egypt, and Nigeria. So there's a lot of scope to grow trade. There's a lot of scope for Nigeria to benefit from this agreement, and particularly not just in Nigeria but also in the West African sub-region. When will it come into effect? We plan to release the framework for this by next week, and the settlement banks have been chosen. The settlement banks will be Standard Chartered Bank and Stanbic Bank, that has its own affiliate bank, ICBC, that's Investment and Commercial Bank of China, that will be the correspondent at the Chinese end. So, I repeat, it is a negotiation that was painstakingly done, and it will naturally be positive to Nigeria. And I repeat, whatever conclusions you want to make from this, you are free to make, but it can never be negative to Nigeria. 2, the first question was about what are the creative ways or innovative ways that we are going to adopt to encourage deposit money banks to increase credit, to accelerate credit growth to the real sector of the economy. As much as possible, we would not want to go back to the era of preferred sector lending and sectoral allocations and all that. We would not, because that is not supposed to be the intention. But we will try as much as possible to come up with some prudentials that will relate loan deposit ratio with the level of cash reserve that the bank holds, so as to direct a bank or compensate a bank that has done a lot of work in boosting its loan deposit ratio through compensating them with CRR, and penalize those who prepare to keep liquidity and trade on government securities or direct those to the FX market rather than granting loans to the real sector. That framework will certainly come up, and we have tasked our relevant department to work on it. I'm optimistic that multi-policy committee will take that decision in the near term. Yes, that we've been talking about the fact that as inflation trends to low double digit or to high single digit, that we may begin a reconsideration of interest rate. And it is very true that we said this, but you will also observe in the course of this presentation that we said that there are a couple of expansionary fiscal activities that we foresee beginning from around May or June this year. And I'm talking about the fact that at this time we're still spending on 2017 budget. 2018 budget will eventually kick in, hopefully by around June, July, and there will be an acceleration in the rate of spending. And we also expect there is going to be a lot of election spending these in themselves expectedly are meant to expand the economy and spur growth, which I will say is commendable. But we also, because price and monetary stability is a strong mandate, we do know that those expansionary fiscal measures will eventually lead to inflationary tendencies. And if that happens, may reverse the course of inflation upwards and also put pressure on the foreign exchange market. And indeed, we strongly deliberated on the fact that we thought there was indeed a need to tighten in anticipation of the occurrence of these activities. And that's why you could see that a member couldn't be convinced, just stood still and said he wants to tighten. But we would monitor, and I had granted some interviews sometimes, that's why I said that we will be in control of these activities and will ensure that as these activities begin to unfold, that we as the Monetary Policy Authority will also take action that will make sure that the adverse consequences that will arise from these expansionary activities does not impede our objective of bringing inflation down and achieving a stable exchange rate. That is the objective, and that's why we decided to adopt this course of action at this meeting. Thank you very much.
Thank you, Governor. We expect correct reporting from you guys. As we say to you, goodbye and see you again in 2 months' time.
Bye.
In July.
In July.
Reporting the outcome of Nigeria's Monetary Policy Committee meeting as wait and see how long that we will mention the last round.